podcast today.
Thank you very much for having me. Can you just give me a thumbs up, Vanya? Make sure you can hear me okay? Okay, perfect. Welcome everyone to today's Investment Interest Group lecture. See, we got a handful of participants and you are the lucky ones. This is the first time I will have gone over this particular strategy in the Investment Interest Group. I think what makes it interesting is where we are in the markets and what we are seeing from a standpoint of concentration, momentum, and all the different metrics that we look at in the markets. And it's a concept also that I think is a very difficult concept to get a hold of. So I'm going to do my best, unlike my usual modus operandi, I'm going to do my best to speak very slowly and take as many questions as I can along the way, because we're going to be talking about options today. And option, just so you know what an option is, it's what's called a derivative contract. It derives its value from something else. In today's case, we're going to talk about options on underlying stocks or equities. And we're going to talk about, in particular, what are called covered calls. I'm going to go over some of those definitions and we'll go over some examples. And please don't expect to fully understand this concept. Options are very difficult. It's actually one of our big specialties here at SPWM. But it is, I would even say in my world, in the world of financial planning and advisors and brokers, often options are a very misunderstood and very mischaracterized form of investments, because I think people hear the word option, they think speculation, and that's not the case necessarily. Certainly there is a speculative component to options if you are long options, meaning you're purchasing options, either a put or a call. But if you're a seller of them and you are where it's called covered, and we'll go over that definition, then it actually becomes a very conservative income strategy. So without further ado, let me bring up my slides here because we have a lot to cover today. And as always, I want to make sure that you either unmute yourself. If I'm in the middle of a presentation, just unmute yourself and please feel free to interrupt me. There's no such thing as being rude here. This is for you. This is not for me. So if you have a question as we go along, please feel free to stop me and just let me know that you have a question and you want to discuss something a little bit further, or you don't understand something. Vanya, can you give me one more thumbs up that I have the presentation in front? Okay, great, thank you. All right, so I'm finally learning Zoom after 4 years here. This is great. I know you're laughing, Vanya, because you're probably struggling with the same thing. So I call this enhanced income, or the 7% solution, and it's just simply how we use options to create an effective way to enhance retirement income, or essentially supersize retirement income, but without taking undue risk, right? Yeah, everyone can borrow against their portfolio and, leverage. It's called leverage. You're putting debt on your portfolio to potentially get more gain, but that can be a double-edged sword. This is not leverage, right? This is generating income through what's called option premium. So real quick, just kind of give a big backdrop or overlay to, where we're at in the election cycle. I know everybody's super excited about 2024 being an election year and being bombarded with mail and being bombarded with commercials and everything else as we get further and further into 2024. But let's look at it from a financial perspective, right? Historically, pre-election year, third year in a cycle like 2023, has delivered the strongest returns, while election year, which is 2024, where we are now, fourth year in a cycle, has seen the weakest returns, okay? So if you look over there, year 4, the average price change 4%, whereas year 3, 15, year 1, 13, year 2, 6, or year 2, 6%. And for those of you that don't know, the S&P 500 is already up double digits year to date. So we're still here in the first quarter, and the S&P 500 is up, roughly 10%. I would take a straw poll, but I think everyone could probably agree with me that the market's not going to end up for the year up 40-something%. If it is, I will resign from being a speaker at UCSD, because I find it very, I'm kidding, I won't run it, but I find it very difficult to believe that after a year that we saw very robust returns in the market, that you're going to see a follow-on year of 40%. That just doesn't happen. And we've already had a nice run up so far. So the market is primed for what I would call either a pullback, a significant correction, or it could just trend sideways. And we may find ourselves at the end of the year exactly where we are right now. Or we may find ourselves lower or higher. I know that's kind of touching all the bases there, but I would say, if you ask me, where do I think we're going to be at the end of the year? I would say it's either slightly higher, flat, And I would venture to guess, based on what the Fed's predicting with lowering interest rates, which means a slowing economy, which means cooling inflation, that if the Fed really does move 3 or 4 times on the Fed funds rate, that means there's some serious deterioration in the economy. We're seeing some of those cracks already. Hard to predict a recession, and if we'll get there. But if the Fed is predicting they're going to lower interest rates, they don't lower interest rates when the economy is robust. They lower interest rates when they're trying to stimulate. They raise interest rates when they're trying to cool. And so they've already said they're done raising interest rates. And so now from here forward, they're predicting 3 potential decreases in interest rates, which means they're seeing in their data a potential for downside in the markets. I think it's important to remember that, because markets can get extended. This thing's called momentum and trend following, all these different CTAs, commodity trading advisors, that follow trends and have all these algorithms and what have you to make their investment decisions, are going to continue to push the trend to a certain level, and then you hit an inflection point, and then you get a reversal. And right now, based on some of the charts we're looking at, you could see a very sharp reversal. And so I think it's prudent to maybe learn about some strategies that you can protect yourself, and that's what this is. But here's the current issue. If you just look from January of 23 to where we are here in mid-March of 24, I mean, look at the returns, and I just got this off of Y charts, but look at the returns in a couple of different, particularly the Magnificent 7 tech stocks, right? NVIDIA, 512% in a year and 3 months. Meta Platforms, all formerly known as Facebook, 312%. Amazon, 109%. The NASDAQ itself, which encompasses 100 different, mostly tech stocks, up 66%. That is an incredible run for such a short period of time. I realize we're coming out of 2022, where valuations were depressed and there was, a lot of uncertainty, and interest rates were rising rapidly, so valuations had to be recalculated. But this is a perfect example of a bubble building in the equity markets. Now, I want you to remember this. I said this in March of 2024, because you're probably all looking at your portfolios right now and going, oh, great, doing so good. I'm at an all-time high. And that's the time you really want to be looking out below. It's not the time that you want to be continuing to add to portfolios. And here are the things that are, if you lift up the hood and you look underneath, here are the things that we are looking at that are of grave concerns to us. On the left, we have the S&P 500. This is as of March 19th, 2024, is when I took these snapshots. On the right, you have the NASDAQ. And if you just look at the sector weights, right? Microsoft at the top of the S&P, 7.19%. Oops, excuse me on that. Apple, 5%, roughly 6%, NVIDIA, 5%, Amazon, almost 4%, Meta Platforms, 2.5%, on and on and on and on. The first non-quote tech company, Berkshire Hathaway, squeezing in there between the Alphabet A and C shares at 1.72%, and then Eli Lilly and JP Morgan. So tech is just absolutely dominating the S&P 500. If you go over here to the right and you look at the NASDAQ, it is all tech except for Costco, which, be consumer discretionary, right? Or maybe, consumer staple, but most likely consumer discretionary. So this is of concern. And why is that? This is where the money flow over the last 12 months has gone. The yellow line being technology. And if you look at the flat line of 0, there are only 2 other sectors, telecom and industrials. Those are the only 2 other sectors that even have a positive sector fund flow over the last 12 months. So you've got, roughly 60, 70 billion flowing into tech, very tiny little bit into telecom, very tiny little bit in industrials. Everyone else is losing ground. That is not a healthy market. That is a very unhealthy market, with all of the wealth and all of the market capitalization concentrated in very few stocks in one sector. To show you from a standpoint over the last 100 years how anomalous or how outside of multiple standard deviations this is, if you look at the market cap of the largest stock right now, the largest stock in the United States is Microsoft. If you look at the largest cap of Microsoft, or the cap of market capitalization, which just means the value, just so you know, market capitalization is just stock price times outstanding shares. It's how much a company is valued at, like your house value, but it's a company value. And Microsoft is almost 800 times the value of the 75th percentile stock in the United States. And that is an incredibly dangerous market, because, again, everything is crowded into one spot. We have not seen this type of crowding. We didn't see it in the dot-com bubble. We didn't see it back in 2009 in the financial crisis, right? We didn't see it back in the 70s, 60s. The last time we saw anything close to this, and we've actually surpassed it, was 1932. And that's, of course, during the Great Depression. You have the snapback rally after 1929, 1932, the peak, and then we went all the way down to 1939. So just a warning sign. I mean, all these things start to add up, and it's hard to, again, predict when the top comes. I'm not here to predict a top or a bottom. I'm telling you, there's a lot of warning signs out there that something big may happen soon. Here's the top 10% of stocks by size, again, market capitalization, versus the entire US stock market. So every stock available on the New York Stock Exchange, NASDAQ, et cetera, all the stocks versus the top 10%. And the top 10% account for 75% of the market. So 75% of the US stock market is 10 stocks. If you take the entire US stock market, it's, I don't know, 2,500, 3,000 different stocks. All these different companies making things, developing things, entrepreneurs creating things, biotechnicians or scientists creating novel solutions to healthcare problems, healthcare companies finding ways to deliver healthcare to the masses in more efficient ways, vaccines, all this different stuff. But yet 10 companies are 75% of the entire market. Something seem out of place there? Yeah, I would agree. And again, if you look back, the last time that happened was in the Great Depression. A little bit more difficult chart to understand. Some of the things that we watch are momentum and crowding. Crowding just means exactly what it sounds like. Everybody crowding into the same stock, right? And momentum being everybody basically, the herd. The herd is moving. It's not moving. It's thundering that way, right? And in the markets, just like on the downside, the market can be irrational because the herd moves that way. It can be very irrational on the upside as well. And that's what we're seeing right now, or what we believe we're seeing, is a very irrational market. It's hurting and it's moving towards a very unrealistic valuation. Let's go through some of those. Here's a perfect example, a profitability bubble. So one of the metrics we look at, if you go back to the dot-com bubble, a dot-com bubble, so this is what's called price to sales. So instead of paying price earnings ratio, which you may have heard, which is just a stock price divided by earnings per share, and then you get a multiple, meaning what is somebody willing to pay? How many times somebody's earnings are they willing to pay for the stock? This goes to the top of the income statement, which is sales, right? And they're willing to pay for tech stocks 8 times sales, which is higher than it was in the peak at the end of 2021 and 2022. We know what happened to tech next year. The NASDAQ was down 35%. So if they're willing to pay almost 9 times for sales, what you're saying is that management in tech companies is so good that they're going to execute perfectly. Their costs, their develop R&D, all that stuff is going to be so perfect that they're going to be able to get to a very profitable earnings number. And that's just not reality. And you can see the last 2 historic times that we have this type of price to sales ratio, dot-com bubble, and then I don't want to compare it to the dot-com bubble in 2022, but again, NASDAQ stocks were down 35%. Even the darling NVIDIA was down 50% in 2022. Facebook was down, Meta at the time, or still at the time, but it's down 75%. This is what we're setting up for. This is what momentum and irrational behavior creates, is this overbuying, everybody into the same one. Go to your UCSD website, pull up your UCSD 403B, 457 funds. It's why I constantly tell people when they retire from UCSD, they should consider maybe not all their funds, maybe some of their funds, or at least a portion of it, diversifying out of the Fidelity plans. Go look in those Fidelity funds and do a Morningstar and look at the top 10 holdings. I'm guessing it looks exactly like this. They're what we call closet indexes, meaning they follow almost all of these top tech. They're following the momentum trade. And that's why a lot of those UCSD funds were down significantly in 2022. And if you're younger, you're sitting here in your 30s and 40s, you may say, it doesn't matter because I'm still dollar cost averaging in. And I would agree with you. But if you are at a point of your life where you're taking RMDs, or you're about to retire and you're going to be taking money out of your 403B, 457, I think it bears watching or being very cautious about where we are in the market, particularly if your funds are overloaded in tech. So here's the PE ratios versus the last 10 years. So let's instead of going all the way back to the Great Depression, let's look at the last 10 years where tech really rose and became the dominant leader of the pack. Well, tech right now is at 100% of its highest price per earnings ratio since 2013, meaning it is more expensive now than it has ever been over the last 10 years. And that is very scary because who is kind of like when you buy a house and you're so excited to go and get in that house that you're willing to liquidate your bank account for the down payment. You're willing to pay any interest rate. You're willing to do anything because you want that house so bad and you end up overpaying for it. That's what we're seeing right now, or what we believe we're seeing right now in the market with tech stocks. I wanted to get on this AI train so bad. I should have put everything in NVIDIA or AMD or whatever your stock is, but I didn't. So now I'm just going to keep piling into it. And when this thing reverses, it doesn't reverse quickly. It's eye-watering how quickly it can happen. We saw that in the pandemic. We saw that in 1999/2000. We saw that in 07, 08. We saw, and obviously these weren't all tech events, but we also saw that in 2022. When it reverses quick. Sometimes you get the question, why do markets go down faster than they go up? Simple answer, what's the stronger fear? Fear or greed? Stronger emotion, fear or greed? I would say that fear is a stronger emotion than greed. And so that's why, people saying, oh my God, I don't want to lose all my money, you sell. Whereas they may be more hesitant to buy when the market's going up. This is a really hard chart to read. Let me just summarize it for you. There's a professor at Yale University, very famous in the financial world for developing something called the CAPE ratio, which stands for the cyclically adjusted price earnings ratio. Bottom line, you see all these green dots way out on the right side. That's where we are now. So if you take a cyclically adjusted PE ratio, we're trading somewhere in the 40 range. It's historically high. So that is the market backdrop of what I wanted to, for people to think about or consider when they're looking at, allocating more money or cash, or where do I put my money as I'm going into retirement. If I'm on RMDs and I maybe have some big gains in some of these tech stocks and I've done really well, or some of these Fidelity funds have big gains, great, glad that you've been there. Or you have a bunch of cash, you're thinking, what should I do? Well, I wanted to present a strategy to you guys, not to sell it to you, but to make you aware of different ways that you can protect yourself against downside and generate income at the same time. Yeah, participant has enabled closed captioning. That's the first time I've ever seen that. Whoever did that, that's cool. I'll have to ask you if you don't mind putting that in the chat, where you found that button, because I'm not familiar that they could do closed captioning, and that's a great thing to have. Okay, so let's talk about a covered call, because I told you I would discuss covered calls today. That's the main premise of the 7% solution. It's just a conservative option strategy meant to generate additional income from a stock in the form of option premium. Now, I'll tell you the option premium is, it's called the Black-Scholes model, and you don't really need to know it. There's what's called an intrinsic value, extrinsic value. Most simply, the option premium, because it derives its value from an underlying stock, has two components. One is a time value of money component, meaning as time moves on, the option gets closer and closer to expiration, so it compresses the value. That's why you want to sell an option, not buy an option. And the other one is the difference between what the current stock price is and the exercise price, which we'll go over what that is in a second. And again, if you don't understand all this completely after this presentation, I can either send you some more information. We have videos on our website that try to, I don't want to say dumb it down. That's not the right, because it's a difficult concept. But the videos really, I think, try to put it more into a layman's term or plain language. So if you're interested, I'll put the website up or my email address so I can send it to you if you want to learn more about covered call options and how they work. So just simply, if you try to implement the covered call strategy, investor first purchases the stock, and then you simply sell a call against it. And there's all different types of calls. There's long dated calls, which are called leaps. There's short dated ones, a month, 3 months. And then there's a strike price, meaning what price that you can execute them at and they become valuable. And then there's that premium that I talked about. And that premium is uber important, because that's the income component, right? So the potential buyer pays the seller the call option of payment for the right, and that's why it's a derivative. You're buying a right to do something. You're not actually buying something. You're buying a right to do something at a given time and date and given price. And the seller of the call option keeps the premium regardless of what happens, right? If the buyer exercises their right to purchase stock, generally after it exceeds the strike price plus the premium, the seller is obligated to sell the stock. And that's called assignment. And we manage assignment in qualified accounts, meaning in IRAs, 403B, 457. We manage it very differently than we do when there's a tax consequence. And I can answer those questions if someone has one, how you treat those two differently. But I don't want to get too much into the weeds since we have the basic. This is just a basic introduction to covered calls. I'm going to focus on the right side here. What is the objective? Like, who would a covered call strategy be appropriate for? Well, if someone wants to generate above 7% income, right? And I'm talking about income, not necessarily capital appreciation, but income. Where do you get the income? Well, 3.5% dividend yield by buying the right stocks that have, high-paying dividends, growing dividends. So your dividend isn't just high for one day; it's been going down, but that they grow that dividend. And then 3.5% from the option premium, which I discussed earlier. Which, by the way, in an election year or when the market gets more volatile, option premiums go up. When the market is rapidly rising and volatility is down, option prices go down, or at least option premium goes down. So equity market participation, someone that wants to participate in the stock market, but wants to be significantly more conservative than just owning stock. I call covered call options a bifurcation or somewhere in between owning fixed income and owning stock outright. You don't have the exposure of owning stock outright because you're hedged with covered calls, and you don't have the risk in fixed income of not getting any capital appreciation. You're just getting income. So it's somewhere in between the two of those because you have an income component and you have a growth component. And then protect your investment capital, and we'll talk about how you can protect your downside here in a second. So our particular enhanced income equity strategy, go back to 2011, and this is just the annual income it's produced. This is a component of the blue portion, right, which is the dividend yield, and then the yellow portion, which is the premium income, right? And you put those two together, and this is what you get for total income from the portfolio. Now, you look at a year like 2022, where you have over 7% in income, and you essentially, if the S&P 500 is down 21%, NASDAQ's down 35% in 2022, you already have a significant buffer to that downside protection. And that's where the downside component comes in. If you have this income coming in, it helps significantly. You can see the strategy has averaged about 7.6% in income since inception. And that can be considered downside protection or just income. So top holdings as of December 31st, 2023. So you kind of get an idea of what they are. You can look at them over on the left. On the right, I think is a little more interesting. If you take the Russell 1000 value, which is just an index of the 1,000 largest value stocks, you could see the gray is where they have most of their money. I say their money, just the index's money. You could see primarily in financials, whereas the particular strategy that we run is half of that. We're much higher in utilities, real estate, communication services, and consumer staples, which pay, usually significant dividends and growing dividends at that. So just some of the metrics, if you look at, you go back since 2016, the average dividend increase in this type of strategy, and this is just our particular strategy, but there's all kinds of them out there, 7% increase in dividends. So that means each year over the last, 8-9 years, you're averaging 7.3% increase in just your income. Again, is this an investment strategy if you're in your 30s or 40s and you're looking for maximum growth? Absolutely not. This is much more a strategy for those of you looking for income in retirement, taking RMDs. This is where I love it the most, is in a retirement account taking RMDs, because if your RMD is somewhere between 3 and 5%, just the income suffices it. And I've got a slide coming up here in a little bit that will show actual 3, 5, and 7% withdrawals and what a portfolio would have looked like. So what's the basics of it? It's a covered call only. It doesn't mean every single stock is covered with a call. Usually, 25 to 40% of the portfolio is covered. The options that we look at tend to be 20 to 30-day options. So they're very short term in the option world in duration. They're very dependent on option premium and then the underlying stock and the movement. The actual process right, is to screen for, different options that meet minimum thresholds over on the left here. Typical analysis, company valuation, timing of dividends. There's a lot of options around the timing of dividends because a lot of folks will use options to exercise right before a stock goes ex-dividend, which means you get the dividend payment. So there's a lot of management around that, very active type of strategy, which again is why I say it's really good in the qualified account space. And when I say qualified account, I mean 403B, 457, IRA. Well, let me rephrase. You can't do it in a 403B, 457, or I don't think there is a path for that in fact, I know there's not a path for that in the UCSD retirement plans at Fidelity. So you'd have to roll to an IRA, and then you can do it with, whomever your advisor is or Fidelity, or you can obviously reach out to us. And then after a position is covered, meaning you've sold an option against the underlying position, we don't buy back the calls. We usually let them assign, unless, of course, it's a taxable account, and then that's on a case-by-case basis. Let me just go over one example. Everyone's familiar with Merck, very large healthcare company. So October 110. So the stock price, let's just say on the given day, and I think then the disclosure says what the given day is, but $107.61 is the stock price, right? You're selling, because remember we're selling covered calls, the October 110 strike. You get $1.31 premium received. So that means the call gives you on a monthly basis a 1.23% dividend. Let's call it dividend, but it's a premium yield. That would equate to 15.51% annualized, right? And then the call actually returned 3.44%, which would be 43.28% annualized because it did not get exercised. Just giving you an example there, I know that may be a little bit confusing, and I understand because it's, again, a very tough concept. So I'll save it for the end chat. We can go over some more examples. What I really want to go through is some of these withdrawal studies and how it works out. So let's look on the left side there. This is if you had a 5%, so 5% annual withdrawal rate. You start in 2011 at a $1 million investment, net of a 1% fee. So you're really withdrawing 6%, right? 5% annual distributions, 1% fee, all right? And so that is your profile here of your income each year. You see total income net. You see 2011, 12, 13, 14, all very good years in the market. The underlying stocks appreciated. You got dividends, premium yield, and so the income actually rose. And then as we got later into 2016, 17, 18, 2018 was if you guys recall, it was, we were down 20% in the month of December alone. And so it was a challenging year from the stock market. It was down, I think S&P was down 5-6%, something like that in 2018. But you still had that income as a buffer. And what ended up from the strategy, if you take that entire time frame of 2011 to the end of 2022, so we're including 2022, which was a really bad year. You took $722,900, taking out that 5% per year, and your ending portfolio value was 1.372. So you started out with $1 million. And 12 years later, you have 372,000 more, but you sufficed a 5% withdrawal rate and a 1% fee for that entire time. And so you took out roughly three quarters of $1 million, and you have a higher balance 12 years later. And this includes the pandemic market, where we're down 35% in a couple of weeks in 2020. This includes 2022, where the market, S&P was down 21%, 20%, NASDAQ was down 35%. This includes 2018. So this isn't cherry picking a bull market. This is actually, 3 out of 12 of these years were pretty disastrous years in the market. And yet you still were able to take out $750,000, and your balance is now 1.37. So again, this isn't the hare, this is the tortoise, right? This is slow but steady, driving income, writing calls, taking out your withdrawals, and still having capital appreciation. Again, if you decided, okay, 5% is not enough for me, I want a 7% withdrawal rate, you can see over here on the right, you would have taken out $906,224, and you still would be higher than the $1 million you started out with by 8.2%. Again, this is 12 years, so that wouldn't be a very good return from a total capital perspective. I mean, what I mean by that is on your $1 million. But you also took out $906,000, so you essentially had the value of a $2 million IRA after starting out with one. What you're aiming to do in this type of strategy is really reduce the volatility in your portfolio. The left side of this shows a 3% annual withdrawal. Let's say you're someone that has a pretty high pension, or you're living off of spouse's income or whatever it happens to be, and you come up to RMDs and you're just starting your RMDs, but you want to let your IRA grow as much as possible because you're leaving it to a charity or you're leaving it to your children, whoever your beneficiary is. So you could see here, if you took out that lower amount of income, you're not taking that $906,000 that you do at 7%. You're taking out 3%. So you've taken out $500,000, not almost $1 million. Taking out $500,000, and your ending balance in your IRA is $1.730 million versus $1 million. I think most people will be pretty happy with that kind of return and still sufficing their RMD every year. And it's why I love this particular strategy for RMDs. I think it's a nice balance of stock and bond without having all the confusion of rebalances and this and the other. It's just simply using that 7% income to generate the income and protection and return that you're looking for. I'm going to skip that one because not a lot of people in here are in the accumulation phase of their life. Most of you are in the distribution and or in the income phase of your life. If we just look at standard deviation and we look at return, Russell 1000 value has an actual higher overall return, but what are you doing? You're risking significantly more risk. You take us back and you give up 1% over owning an index by itself of 100% stock, and you take your risk down roughly 20% from 15 standard deviation to roughly 12 and a quarter, and you are only giving up 10% of your income, or excuse me, total return. Just wanted to go through some of the things and highlight, well, Ryan, what does it actually look like? What do returns look like? Let's take a look back to 2012 here, okay? Remember I said, or 2011, remember I said there were 3 pretty nasty years over the last, since 2011 in the markets? 2011, 12, 9.6, 21.8, 2013 S&P was up 33. So you're giving up some of that upside. 2014 S&P was up mid double digits. You gave up some of that upside. 2015 S&P was flat. You were flat. 2016, 2017 underperformed, S&P. 2018 you outperformed, even though it was still down 4.1%. But take a look at 2022. I think 2022 is still pretty fresh in everyone's mind. But if I started you out on January 1st, 2022, and put you in the S&P 500, and you were down, 20% for the year, and you were in a portfolio that was actually up 2% for the year, paid you that income, I think most of you would be pretty happy. And that's really what a covered call strategy aims to do, is to protect the downside. If you're looking for mass, appreciation and growth, it's not your bailiwick. If you are looking for income, again, RMDs, protection on the downside, it's certainly something you want to take a look at. I don't really want to go too much to that. I just want to now just kind of talk about dividends and why we think, everything from the last couple of years has been, particularly because of low interest rates, growth. Well, now we believe that we are potentially moving into one of the renaissance, if you will, of dividend stocks, because they have lagged versus the S&P 500 by the biggest margin since the dot-com bubble in 1999. And usually when something gets to that type of dispersion or standard deviation away from its norm, that's when you get the reversal. In 1999, that period was followed by a 10-year stretch where dividends outperformed by a wide margin. And you can see it right there. It's in the box, the hash mark box. And again, we're in this period since 2014-15 where dividends have absolutely, or dividend stocks have just been left to the side. Now might be the perfect time to look at dividends. Look at 1999 and the similarities to 2023, where dividend stocks essentially underperformed by one of the widest margins ever, and almost as much as 1999 when everyone was chasing tech growth stocks. Sound like a familiar story? Well, it does to us. Here's again the S&P 500 sector performance in 2023, right? You can see tech, comm services, which is a lot of tech, and consumer discretionary. All the riskier stuff did really well. And all these dividend paying stuff, utilities, energy, consumer staples, healthcare, financials, did really poorly. And things don't just stay like that forever. And we think now is the time, or potentially now is the time, where these dividend paying stocks, or these sectors that have been thrown to the wayside, really start to outperform. And let me take you back to what I said at the beginning of the presentation, which if the Fed is sitting here saying they're going to lower interest rates, 3 times is their prediction, for 2024. What are they telling you? They're telling you that they see a softening economy. They're never going to say recession because they would not want to do that. They'd lose their jobs. But they're going to say they're flashing a warning sign, right? The light is yellow and it's flashing at us. And I think that you have to listen to the Fed because it's the biggest driver of the equity markets here in the United States. So here's just simply the performance of staples, healthcare, utilities, and telecom versus the S&P 500. And again, we can look all the way back to 1970, and the performance versus the rest of the S&P 500 is at an all-time multi-standard deviation low. And these, again, are the things that we're looking at and going, wow, this could really be an inflection point for these type of investments. Here's the dividend contribution by return for each decade, right? You can see the average of total S&P 500 return has been about 59.4%. We have not seen it lower, including all the way back to the 1930s, into the 2020. Excuse me, 2020 is the lowest decade going all the way back to the 1930s. And you can see in the 1990s when it was the second lowest, or almost the second lowest, that we had an incredible increase in 2000 of the performance of dividends and how they supplemented the S&P 500 return. And many people know 2000, 2010, they think of it as the lost decade, meaning there was literally no return in the S&P 500. Not true, again, if you were an enhanced income strategy. Does that mean that's exactly what's about to happen? It's hard to predict, but I would say it's something worth taking a look at and seeing if it's time to start making changes and booking some profits. Just remember the old adage, investing, no one ever lost money taking profits. If we do happen to go into some type of recession, here you have the S&P 500 earnings per share during recessions, right? And the drawdowns, the S&P 500 dividends per share during those recessions, right? They've been much more resilient. You can look and see in 2020, when we had the 35% drawback, right? The earnings per share was down 14%, but the dividends were only down 3%. And even in the financial crisis, and remember, what was hurt the most in the financial crisis? Banks. The banks are usually one of the highest dividend payers. Dividends only took half the haircut that the actual earnings per share took. So dividends are a wonderful ballast to a down market or a slowing economy or even a recessionary economy. Let's skip that one for right now. Median sector returns in the year before an election day, right? So you can see here, if the 12 months before an election, defensive sectors have outperformed historically. Utilities, staples, and energy, which are all defensive, have led, while tech has had the biggest margins of underperformance. We've seen this momentum carry tech in the beginning of 2024. Are we starting to see peak tech right now? Again, I'm not here to call a top. I'm not saying, this is what's going to happen, that's what's going to happen. I'm just going with history and historical charts, historical values, and things that have happened in the past. And of course, at the bottom, we always say past performance does not guarantee future results because it gets us all out of trouble. But you have to start paying attention to these things when they're screaming at you. And we really do believe they're starting to scream at us right now. I know how good the Magnificent Seven were in 2023. You can see the returns there in the blue. But people tend to have the short-term memory and forget. You have to look at investing as a longer-term thing. If we go back to December 21st, 2021, and we look to the end of 2023, only 4 out of 8 of the Magnificent Seven, let's call them 8, we're just adding Tesla in there because it was a darling in 2023 and it was a darling in 2021 and 2020. But 4 out of 8 of the stocks have a negative return over the 2 years. The one darling is NVIDIA. Microsoft, Apple, and Meta underperformed the S&P 500. So again, is this a rotation out of tech? I would say right now we're in the momentum, the final last gasp, of air, but I could be wrong. It's just that all these charts and everything is pointing towards, going to those things that have been thrown away to the wayside. And I don't like to just try to guess and move from sector to sector. I like the enhanced income approach to put, and I'll be very transparent here. My entire 401k is actually in the strategy because I do believe we have seen the growth and momentum peak, or at least get close to that. I can't predict the timing. But I'm able to move strategies very easily within my 401k plan because, first of all, I run it, and second of all, I'm not subject to a plan that only has certain mutual funds and all that stuff. So with that being said, we're 40 minutes in. It's one of my longer presentations. I apologize if it was long, and I know it's very, very data intensive and complex, but I I want to open up the chat or open it up to anyone that has questions. I know this is a tough topic, but Vanya had requested we talk about dividends. So I wanted to talk about dividends on top of how to enhance that income, possibly for RMDs or a qualified account. So with that, I'm going to put my email. If you have questions offline, you don't want to ask it on here, but please unmute yourself if you have a question. Or don't. Anyone? It was just so amazing that got options all figured out, or was it just incredibly difficult to understand the concept? I know it's a very, very complex concept, so please fire away if you have anything, but not all at once. All right. Nothing in the chat? All right, Vanya, it seems like we, oh, there we go. Complex but helpful. Diane, yes, I know it's very complex. Let me just leave you with a couple things here that I think are really, really important to understand, okay? Great info, Linda, thank you, I really appreciate that. Let me just, if I can just leave you with a couple things. History can be a guide to us to give us probabilities. It's not, this is what's gonna happen because it happened in the past, but we are in an election year. Anyone else out there think this election year might be a little volatile due to all the angst, political unrest, how far apart we all are on the political spectrum, all the fighting that's going on. Let's never mind geopolitics, the rise of terrorism again, wars in all these different places. Is it fair to say that those could be catalysts for a much, much more volatile market? I would say yes, right? And year 4 typically, meaning an election year, tends to have muted returns, right? So why not build in something that has an enhanced income component to it? That's what we are proponents of. I'm not saying that's definitely what's going to happen. Look at these incredible run-ups in these tech stocks. Things reverse. They just don't go up forever. Here again, here's the S&P 500 and the Qs, and compare that to what's in your, Fidelity mutual funds. Go look at Magellan, or go look at Fidelity large cap stock, or the UC funds. They're going to look almost exactly like this. That is the overcrowding that I'm talking about, and that's going to unwind itself. And this chart, I think, says it all. This cannot continue. Money will not continue because there'll be no more companies out there. Companies will just go under. They're not getting capital anymore. But we know that there are other companies. We go to the grocery store. That's a different company than tech, right? We go to Costco. That's not tech, right? There's biotechs right there around UCSD inventing incredible vaccines and solutions to different problems of the world. That's not information technology. It's biotech, a form of tech, but it's not information technology. We know there's healthcare companies out there delivering healthcare around the world and here that novel approaches and all this stuff. We know that there's industrial companies that have to build bridges. I mean, who didn't see the bridge that was struck in Baltimore today, the Francis Scott Key, which brought me back to my grade school because I remember he wrote the Star Spangled Banner. But I mean, someone's going to have to rebuild that bridge. That's going to be an industrial company, right? And so again, and somebody's going to make the steel that's going to go into that bridge, right? That's a materials company. So there's other companies out there that have value, and all the money has gone into tech. And I truly believe, and you'll be able to come back to this video on YouTube and say you were wrong, Ryan, which is fine, because I am wrong, a lot of the time. But I truly believe now is the time you need to look at protecting your portfolios. And I have another one here in the chat. Great intro, thank you so much. Yes, looks like it. So my email's in the chat. If you want to look on our website, we do have a video that I think is much better at explaining options than I am, because I tend to go too high level. It's right there, and then you can click on our videos, and then there's a video on covered calls, and it tries to simplify it. And if you have any questions, feel free to email me. And thank you, everyone, for coming to the Investment Interest Group. It's good to see you all. Thank you, Vanya.